Let me now bring on board Sanjay Dutt, Managing Director and Chief Executive Officer of Quantum Securities. Sanjay, what a delight to have you back on ET Now. Sanjay, Indian markets have appreciated by about 20% plus this year. Individual stocks have appreciated by about 30% plus this year. So what's been your portfolio strategy of late? And in your personal portfolio, are you buying, are you selling?
I think fear is still there. In fact, more than fear, there is skepticism at this point of time. But I think the focus should now be towards the mid-cap stocks. There are a large number of mid-cap stocks which still haven't run up, but fundamentally much higher valuations are justified. They need to do the catch-up act. Some of the large caps have run up quite a bit, which were beaten down, the ones which I defined as by fear. But I think good quality mid-caps is the place where one has to look to buy into companies and remain invested for the next 12 to 18 months, because the beta and the traction that you'll see in them once the interest rate cycle and the demand uptick starts kicking in with the infra spread and the policy action that the government has got in the pipeline, they'll be the biggest beneficiaries, and you'll see substantial leverage coming out, operating leverage in their balance sheets appearing in the years ahead.
Sanjay, for those who bought defensive stocks in the year 2011, not only they managed to outperform markets, they also made money. But given the way how market dynamics have changed, is it time to log out of defensives, or your view is that global risk is still evident and defensive stocks could still make a comeback?
You may not log out of defensives, Nikunj, but I think you definitely need to be underweight on the defensive and have a little more beta in your portfolio right now. Because I think there is a lot of traction in some of the beaten down mid cap and some of the large cap names where a lot of work the companies have done. Their balance sheets are reasonably good. They may not have too much debt, and even if they have debt, a lot of debt would be restructured. A lot of debt would now get refinanced at lower rates, or in fact the interest rates would come down, and you would see that leading to substantial operating leverage, as I mentioned earlier. So to say that we totally out of defensives, no. You must have defensives in your portfolio, but you should be underweight the defensives. That's what my call would be for 2012-13.
Hi Sanjay, morning. After the recent run-up in the market, where do you still see bargains?
Well, I think in quality mid-caps, if you look at the BSE 500 and the BSE 200, there are still a large number of companies which are quoting around their book value or just marginally above their book value, or companies which are quoting at half-time sales or just about one-time sales, are businesses which are going to grow at 15-20% top line and maybe higher on the bottom line. Their end products have got traction, but their margins have been squeezed because of input costs as well as fund interest costs, as well as availability of liquidity for financing their products. So these are the broad areas which one should apply, and looking at companies. If you see a company which meets even say 3 of the 5 criteria that I mentioned, or 4 of the 5 criteria mentioned, I don't see any reason why one would get about 30 to 40% return in this year from these companies with a risk reward of say about 10-15% downside on a correction.
And you're sounding convinced to me that this is beginning of a new bull market and this is not a bear market rally. Why are you convinced that this is not a bear market rally? Because historically, if I look at the last 10-year chart for Indian markets, we've seen bear market rallies, and bear market rallies have taken this market up by 35 to 40%.
Because the difference is that in this aggressive bout of correction that we saw a large number of assets being totally dislocated. And I mean by that, which were totally, I would say, disconnected with realities. And what I mean by that is, look at currency, what we saw in most of the emerging market baskets, particularly the Indian rupee, the way it suddenly went totally out of whack. The sentiment went completely negative. RBI went on the aggressive side on tightening. In addition to that, we've had policy paralysis. And what we saw in India in the last 3 months of 2011, calendar 2011, in fact, I think was worse than probably 2008 crisis that we experienced in India in the financial markets, particularly in the equity markets. So most of the leverage portfolios got completely cleaned out. Retail investors were out of the market. There were huge short positions. And that's what differentiates the position what we were in last quarter of calendar 2011 versus most of the bear market extreme situations that we saw. And coming out of that, what we've seen, both the currency improving, the liquidity position improving, RBI action happening. It's a clear signal that it's not just a pure bear market bounce, but actually a fundamental shift that is taking place. And I once again repeat, I see the fundamental shift primarily on two accounts. One is policy action, and second is the central banker action, because the central banker was the first one, if you recollect, way back in 2010, aggressively started tightening, and the implications of that were what we saw in calendar 2011 on industry balance sheets, on company balance sheets, and not necessarily equity markets prices as such. That has changed for the positive right now, and that's what I firmly believe is changing in a trend of the market from a bear trend to a bull trend right now. Yes, we might have substantial retracements as we go along, but definitely it's a buy on dip kind of a situation versus sell on every rise that we normally do in a bear market.
What are your current bets? In your personal portfolio, where are you ready to allocate disproportionate amount of money, or you have already allocated disproportionate amount of money?
Because interest rate sensitives, I'm very aggressive on at this point of time. I've been buying banking and financial services for the last few months. Infra selectively, I've been buying mid-cap companies across sectors, which I've been repeatedly talking about, whether it's in steel, whether it's in consumer durables, or wherever they are, good quality companies with very little debt. Some of the companies which are catering to the agriculture or a proxy agriculture play, I like those companies because I think the rural demand is going to be on the uptick again post budget. So a mixed bag of these companies, particularly in the mid cap segment, I like a lot, and I think you've got multi-baggers there for the next 2 to 3 years.
BHEL is also on a tear, 12 rupees up for BHEL. So Power Ancillary, BHEL appreciated by about 3% plus yesterday as well. So about 290 rupees now for BHEL, and it is moving up on very, very strong volumes. Sanjay, final question. It has taken $4 billion for Nifty to move from 4,500 to 5,500. What will take Nifty to scale up now to 5,500 to 6,000?
I think liquidity is a key element for the markets to sustain the momentum and move up. Of course, we would need flows as they are. We wouldn't want the flows to turn negative. But most important is we need broad retail participation and broad domestic participation, primarily from the private client group and the retail investors. Unfortunately, they tend to come in at the wrong times. I hope it doesn't happen this time, and they are sensible enough to take the right calls in terms of stocks, in terms of entry strategies. I think the wider participation still hasn't happened as it normally happens in very vibrant bull markets. And I think that's what will keep the momentum up, because most of the people are feeling left out. The ones who are short haven't got a chance to aggressively cover their shorts as yet, or go long, or take reverse positions. And that is what I think will protect the downside around the 52-5300 levels, even if we do have an aggressive correction in the weeks ahead. So a combination of these two, I think, will keep the momentum up and will take the market higher, or at least consolidate at such a level where we are today.